Good morning, good afternoon, good evening, and welcome to the TGI. Thank God it's Friday, the 10th of February, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone, to the Friday webinar. Apologies about technical issues yesterday. Lost my internet, couldn't get it back up again. Oh, disaster. So my apologies. There was a very late cancellation of the webinar yesterday, but beyond my control, I'm afraid. All good today, though. It's going to be, I haven't got a huge amount to say anyway today. Probably going to focus a little bit more on the technicals. There's not a huge amount going on. Been a bit of a pools week. I'll just talk a little bit about that. Up until we're actually on an inside weekly pattern, meaning that this week's high and low are within last week's high and low. And that's often a sign of consolidation, digestion, markets having a bit of patience. And not surprising, we had a huge week last week, which I really focused on, Wednesday through Friday. Three major central banks in play, Bank of England, ECB, and obviously the Fed. We had Alphabet, Amazon, Apple and Meta all reporting Wednesday through Thursday. And then we also had the employment report. And on top of that, we had the PMI data. So it was a massive week for macroeconomic data, central banks, and earnings reports last week. Markets and on the back of a very strong January to go into February, also very strong. So probably no surprises that we had a dip back lower this week. Consolidating for most of the week, dip back lower yesterday. Slight negative technicals, so look at that shortly. And ahead of what is a big event next week. Remember, we've looked at this previously and just dipping back to the charts and here, the big moves that we've had. So just looking at the Nasdaq, for example, in here, the big moves that we've had around the CPI data. Well, let's look at the better probably to look at the S&P. So this day here, the actual low was the CPI date. Then 1 month later, this huge day, nearly a 6% update in November. And then we had a significant down day here in December. January's data was actually a little bit quieter. And then we get next week, we get the CPI data. So as I say, but we're in inside weekly patterns still in here at the moment. And that's no surprise to me, given the amount of big macro data and events, fundamental events we had last week, and then the big event next week, the big data event next week. So a little surprised that we're in more of a consolidation mode going into through this week. Just talking about the data, though, we have had some significant data out of the UK today. So the UK is grabbing headlines here, just missing a recession. So the previous GDP number in here, the quarter on quarter was minus 0.2. We were flat, so zero. So just avoiding recession. Remember, recession, 2 successive quarters of negative growth. Okay, so we have minus 0.2 for the Q3 data. The Q4 data is zero, flat, so just missing. But we look in here, the industrial production and manufacturing production data actually in the green, so positives there. We also had some Chinese data in here overnight, so not showing up on here, but because it's actually probably being picked up into yesterday's data here. Yeah, so look, CPI data. Mostly better than expected in here. Remember, red is actually a positive in this case in here. And also trade data was positive for China overnight. So those were some positives going back in here to today's data. Looking ahead, very little of note. We've got the Canadian employment report, probably not going to impact markets too much. Michigan consumer sentiment, sometimes that does have an impact. It's a 10 o'clock data, sometimes miss, always on a Friday. We're watching out for that just to see if that has an impact going into the end of the week. Just run through 5 things to start your day in here. Not a big deal in here. Russia plans to cut March oil production. Potentially a nomination for a new Bank of Japan governor in here, and potentially in here to replace Kuroda in here, and the market's taken that as a potential hawkish move. Okay, so the yen has rallied on the back of that. Global pensions crisis, nothing that's going to really impact us, and futures lower after a negative technical signals last night, shifted negative on our views on the dailies that I upload, the technicals that I uploaded for Nasdaq and S&P last night. and certainly looking more negative, even more negative with the sell-off in here today. I'll touch on that as we go through. So stocks futures lower in here, and bonds also falling lower prices, higher yields on concerns about a more hawkish tone. I think coming through since the perception of a more dovish tone last week. I think Fed speakers near pushing us more on a hawkish path, saying rates could be higher than the market is pricing in. No rate cuts coming. So there's the current account surplus that I was talking about in here. And also consumer inflation picking up and gathering pace out of China. And there's the BOJ, the new potential Bank of Japan governor in here, seeing as a more unsurprising, more hawkish choice. Futures fall amid rising yields, also covered out of Reuters. And Barkin more, reiterating, if anything, a more of a hawkish tone here. The Fed's foot is unequivocally on the brake pedal. Volatility, sir. So volatility picking up slightly with this sell-off that we've seen, having been quite tepid more recently, and certainly up to yesterday. Given that consolidation pattern we've seen, and the pound is falling as the UK has hit that zero growth. European exchanges down notably in here today. The FTSE's the outperformer, down still 0.6, but you look over 1% down on the German and French indices. And we look at the having had a dip of about 0.75% for the Dow and just over 1% on the Nasdaq, nearly 0.9 on the S&P yesterday, down further, and Nasdaq really leading the way now down. With that move to the sell-off in bonds, lower prices, higher yields, more impacting the higher yields, impacting the Nasdaq more. And we can see that a little bit in here with the peak in here. If we look at the going out here now, we're still pricing in a rate cut by the end of the year, okay, but that's becoming less of a chance in here now, and the peak's still staying in here at 500, 525, but this is becoming an increasing chance now, the 525 to 550, the potential for us to go to September. This is for July. See, this is creeping up, the 520 to 550, showing a growing risk of a higher peak in rates, okay? And that higher peak in rates, the move to the sell-off in bonds to higher yields, weighing on the growth stocks. Let's take a look at the charts. I think it's more important to take a look at the charts now. So if we go to the 15-minute chart on the NASDAQ in here, we kind of confirmed yesterday's sell-off. It's not a classic double or triple top, because we've got higher peaks over here, but kind of like a double, triple top in here, almost a quadruple top. 1, 2, 3, 4 highs, down through that low there yesterday around 40.98, signified that. And you can see then the market bouncing back to that 40.98 level. You bounced to it here after the first break and then bounced to it again. So it's using this as a resistance now. Okay, that point you can see twice. So after it broke, it bounced to the 40, back to that 40.98 level, and now using that as resistance. Okay, and down lower again in here today. So you've got this kind of quadruple top here, and similarly we see that on the NASDAQ. Okay, so 1, 2, 3, 4. It's not kind of classic because we've got actually a down slope there. But look, since we broke that low there, then the market broke, bounced back to that low, broke back, just below these lows, string of lows actually here around the 12,460 kind of area, 455, 460, and using that as resistance and lower again in here. So I do think there's risk. We shifted more negative yesterday. I do think there's risk of this going still lower, but this is the qualification. I think the initial risk is lower, but I wouldn't be surprised to see a bounce at some point today, guys, right? Look at this trend line. So this is the trend line that comes up from the beginning of the year through the lows in here towards the end of January, and we're sitting right near that trend line. I think we could break that trend line, flush out to the downside, and then get a bounce. So I think the risk today is down, then back up again. And then it might see a shift lower into the close. And again, the same trend line from the 6th of January through the low in here on the 19th and 20th of January. I wouldn't be surprised to see us flush down to that trend line, have a go at that trend line, maybe break it, and then pop back higher. Maybe not even into close. Maybe then we get a weak close. So down, I think initially, you may pop back higher after down. Then it might be another sell-off into the close. Okay, so I just have to. I think you have to be ready today to trade in multiple directions. I don't think it's a straight down day. I do think the initial risk is down, but then maybe a bounce. So watching out for that, guys. Yeah, watching out for that trend line. Those trend lines that come up from the 6th of January on both the Nasdaq and the S&P. Let's take a look at the bond markets first of all. So yeah, a slight bearish outside day yesterday and then lower again. This is the 10-year note. Okay, so bearish outside day, a higher high and a lower low. So a negative pattern breaking down in here and look approaching now. The risk I think is down to these two impulse lows. So for the 10-year note, the risk today is still lower. 12.20 and a half, 12.18 and a half, these two lows. So that's my downside target on treasuries, 10-year notes. Let's take a look at gold. So gold in here, we said about being a dead cat bounce. We saw the set off yesterday, lower again this morning. We have had a bounce, but this looks negative. Dead cat bounce, lower yesterday, stepping into the 30-minute chart now on gold. So there's the dead cat bounce. The market kind of breaks out of that. We have had a rebound, but then trading back lower. So this stays bearish for me in here for gold. And if we take a look at oil, where's my oil chart in here? Here's the daily on oil. So strong day up today in here on that announcement from Russia in here. We're already recovering anyway for the week. Strong dipping a rebound yesterday, pushing higher. We've had a big up day already today on the back of a big up week. Can we go higher? I'd probably prefer, if it was me, I'd be leaving this one alone. As bullish as this looks in here. Okay, so we had that impulsive move this morning, overnight, / this morning, dipping low in here. I'd have to play it from the long side, but I think the risk is that we've done most of the work already today. So just have to be a little bit careful on that one, guys. Okay, so yeah, just be careful if you're looking to buy this, that the upside could be limited because we're already on we're already on a really big up day already on the back of a really big up week. So I think, maybe back up towards that 81.00, but probably not much higher than that on oil. Okay, I'm going to wrap it up there. Any questions? Rarely get any questions from you guys. Anything you wanted me to look at that I've missed? Any questions on anything I've said? Otherwise, I'll wrap it up there. All right, guys, going to wish you all a great trading day. Stay safe, take care, have a great weekend too. I'll be back with another bull versus bear webinar on Monday.